The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Deep Sixes, the deep AI tech trade. Live from deep in Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
I'm Alex Steele. I give you a lot of props for being able to say all that without messing up.
I wasn't sure I was going to get through it.
It's a fair point. We are monster de-risking here in the U.S. market. The S&P is off almost a full 2 percentage points. The NASDAQ 100 off by 3.5%. Yes, we are off the lows of the session where we opened, but nonetheless, a very brutal day. So where does money go? It goes into the safe havens. It goes into the yen. Dollar yen now down for 3 days in a row. The 10-year yield's down 9 basis points. Money flowing in to those safe havens remain.
Yeah, and a hard lesson today for investors really about value at risk, and well, an even harder lesson for companies about ignoring that black swan that had been sliding into its DMs for quite some time. Chinese firm DeepSeek has been known for months, and for at least the past 3 weeks, its chatbot has shown it could punch up in weight at a fraction of the price. So it says. That's raising a lot of questions about the hundreds of billions of dollars being spent by U.S. tech heavyweights to fund that AI fever dream. NVIDIA, by far the biggest beneficiary of that capital expenditures, on pace for its biggest percentage drop since March of 2020. Marvell Technology, which offers AI accelerators used by cloud computing providers, that's having its worst day since 2001. And all of those power companies that were giddy over the electricity needs of the AI revolution, getting hammered. Constellation Energy, which started the year with a 55% rally, plunging 20% today. And anytime, of course, you see a major repricing of downside risk, particularly in a seriously crowded trade like AI, chips, and energy, volatility swells along with it. The VXN index of NASDAQ 100 volatility seeing its biggest point jump since December and second biggest daily point jump, Alex, in almost 5 months.
The superlatives just keep rolling off the tongue. You cannot find more superlatives. There are just too many. So this is another way of looking at what's happening with NVIDIA. This is looking at market cap losses in single names. And you can see that NVIDIA right now, and this is as of 10 minutes ago, is losing $620 billion in market cap from today since Friday. And that is the largest on record. The last came last September, and that was NVIDIA again, and then a couple of these are Meta and then Apple. But the point is here, just the extent to which we've seen the decline. We've never, ever seen a market cap decline like this in a single stock name in the history of the stock market. And also, Romaine, I should point out, it's so far above where we saw the last one at about $280 billion loss. It's like, where's the bottom and how do you come back from something like that?
Yeah, the bigger they are, of course, the bigger they fall. But a big question here as to, well, whether this is just a blip on the screen. John Belton joins us right now to kick us off to the close. Portfolio manager and managing director for growth portfolios with the Gabelli funds. And I know your funds are a big holder of NVIDIA, one of your top holdings, at least in a couple of those funds. When you look at a sell-off like this, one that seems to have come out of nowhere, basically we get this, I guess, analyst report, if you will, about DeepSeek, but you go back on the Bloomberg terminal. We've been writing about this for a while.
Absolutely.
Does this worry you?
Well, I think there's so many headlines out there. There's so much news flow. So let's take a quick step back and think about what's happened over the last month, because this news that's really getting all the headlines today and got all the headlines over the weekend with DeepSeek really started, well, I guess a year ago when they released their model called V2, which introduced a lot of these potential breakthroughs. Those breakthroughs came to fruition in a model they released a month ago. Mm-hmm. So a lot of this has been out there. Last week, they released their latest reasoning model. That coincided with the inauguration. There's been a lot of headlines since then. So what my take on DeepSeek is in particular is I think a lot of the advancements that they've made are very real, and it's something to pay very close attention to if you're an NVIDIA shareholder.
I want to read to you a statement that NVIDIA emailed to our reporters, Ian King here at Bloomberg, basically saying that it is an excellent AI advancement, and they say the work illustrates how new models can be created, but they kind of dismiss some of these concerns as somehow this is a negative for NVIDIA itself.
Well, I mean, I think there's clear negatives for NVIDIA. There's also potential longer-term positives, I'd say, too. So on the negative side, what's clear is DeepSeek has created a way to, I'd say, do more with less. Mm-hmm. What they've done, the way I think about it in simple terms, is take a professional certification exam, like I took the CFA exam. There's a lot of ways to study for that exam. One way is you read all 5,000 pages of the textbook. On the other extreme, you just do practice questions.
Yeah.
What DeepSeek did is when they trained this reasoning model, they kind of took the practice question approach. They took some shortcuts, but created something that's definitely good enough and capable enough that was done very cheaply.
I love that analogy. By the way, I did the practice route too, and I failed level 2 twice. And then eventually I just read the book and I
was
passed.
like, but then you passed. So it's okay.
Right.
And it was interesting to see also NVIDIA talk about how the DeepSeek was export control compliant. It was like, please don't restrict us anymore when it comes to exports. Do you buy the dip?
So again, I think with NVIDIA, the best way to trade this stock, or you don't trade this stock, you own it for the long term. And I think 2 points I'd make on sort of the positive side for NVIDIA. What could this do for the industry more broadly? If the cost of AI inferencing, the cost of AI training comes down, it could make the applications more broad-based. It could unlock new pools of demand, new potential customers. So this could be good for innovation in the AI space broadly, which would be good for NVIDIA in the long term. The other point I'd make is, I think this is good for big tech as well. Separate from NVIDIA, I think lower cost of inferencing, very good for a company like Meta, very good for a company like Google, very good for a company like Amazon, companies that have AI embedded in their P&Ls. And then back to NVIDIA, the other point I want to make is this happens from time to time in tech investing. Big tech stocks get left for dead and they come back. This happened with Microsoft many years ago. This happened with Apple after Steve Jobs passed away. This has happened many times with Meta, many times with Google. Amazon was never going to turn a profit. Netflix was never going to turn a profit. These existential questions tend to come up from time to time. That's what's happening today with NVIDIA. I think there are plenty of near-term questions that these companies are going to have to address during earnings this week, but I still am a holder of NVIDIA long-term. Buy the dip is not really how I generally trade NVIDIA, but I'm still owning NVIDIA for the long term.
At the end of the day, though, if we get into a world where we can reduce the cost and you don't actually, you can't charge us a lot for AI services, like the everyday consumer, who is that bad for?
Well, I think, so I'd say, first of all, it's probably bad near term on the training side. I do think it's seeming to be not as important to invest massive amounts of dollars in training to get the best output. I think DeepSeek is showing us that there's ways to optimize your AI spending in a way that hasn't been done yet. So I think it's probably bad for them. For someone like OpenAI and some of the model companies, so Google Gemini would be another one there, I think this is showing that those models commoditize pretty quickly. I think it could be bad for these model companies. We'll see. Again, it's very early. This is evolving very quickly. That's where I'd start as kind of the losers. Then the derivatives for some of that stuff. So some of the industrials, some of the power companies, we'll see how this unfolds. I think near term, probably fewer massive training data centers constructed, but long term, could there be more inferencing data centers constructed? Could there be more AI run at the edge? Could there be more AI infrastructure built in that way? We'll see.
I am curious as to, you mentioned some of the earnings we're going to get. We're going to start to hear from some of the hyperscalers and some of basically the buyers, the ones that have been investing a lot of money in this. Do you think we're going to hear any sort of material change in the amount of money that they've committed to these projects?
Well, Romain, that's one of the really interesting things about the last week. So this R1 model from DeepSeek was launched on Monday. And then the next day you had this Stargate announcement with Oracle and OpenAI, and we can debate how real that is, but a $500 billion AI investment program. And then on Friday, Meta pre-announced unexpectedly their 2025 CapEx plans, $60 to $65 billion, about $10 to $15 billion above the street. So clearly Meta is going all in on this. And I think their Llama models are the closest DeepSeek comp, by the way, a set of open source models like DeepSeek. So to answer your question, will these companies backtrack on the CapEx plans? I don't think so near term. I think the question is more next year, 2027, is the investment cycle finally starting to crest? We'll see there.
We only have time for one quick question, but I do want to ask you about the market reaction to Meta, because when you see all of these other stocks getting decimated, Meta spent most of the session in the green. I think it's now just dipping into the red, but you're not seeing these double-digit percentage losses there. Why do you think investors were maybe a little bit warm on Meta as opposed to some of the other software companies out there?
I think near term, people trading Meta stock, the big unknown ahead of earnings this week, there's two unknowns. What are the CapEx plans? What are the OpEx plans? CapEx plans, those were announced, so that was kind of a potential negative event that they got out of the way on Friday. So that's why that stock reacted okay on Friday. And then today, I think Meta's just a really interestingly positioned company. You've got, first of all, as I mentioned, cost of inferencing going down. That's a direct positive in their P&L, for sure. And then secondly, DeepSeek open source model company. That's what Meta's made a big bet on open source models. That's what they have with Llama. So I think there's excitement about that asset moving forward as well.
And you are a holder of Meta.
We are a big holder of Meta.
So great, John. Really good to get that perspective. Investor take. John Belton, portfolio manager, managing director for growth portfolios with Gabelli Funds. Thank you so much. All right, let's get a check here on volatility, because as you see the market sell off, you see the VIX spike, you see the NASDAQ volatility also spike as well. Joining us now to discuss is Mandy Xu, head of derivatives market intelligence over at CBOE. All right, so this is a day.
Yes.
This is a day for volatility when we're used to volatility being really low. How much can volatility rise, particularly for the NASDAQ?
I think we're still in the early innings. So what is interesting about today's sell-off, yes, volatility is higher, but it's really still very much an idiosyncratic story about AI, about NVIDIA, as we just heard. Markets are not pricing this to be a macro correlated driven sell-off. I mean, in fact, three of the sectors, at least when I walked in here, were up on the day, right? So for someone owning volatility or owning index protection, what they're really playing for is that correlation pickup in the market that we haven't seen. Correlation still near historic low. So I think right now the setup is still for this to be a stock-specific, fundamentally driven correction. The question is, when does it turn? And people have been positioning for a potential VIX spike, much more than what we've seen today, using VIX options.
So now, today, after a day like today, where's the cheapest way to get protection?
So, I mean, if you look around, like volatility is obviously kind of picked up across the board. I would say the non-tech sectors, the non-tech exposure, that's clearly been the outlier. NVIDIA vols up 20 vols, right? And if you look at single stock vols, the difference between that versus index, near extremes, which we've highlighted. So I think still at this point, if you're looking for good value, owning broad index protection, owning broad index volatility, such as VIX, that still makes sense to us in the sense of you haven't gotten that correlated sell-off, you haven't gotten that correlation kicker that could really drive volatility much higher.
I'm always curious about the timing of this. There was a great story in the Bloomberg terminal about some folks who were buying very cheap volatility protection last week.
Yes.
But then I think about earnings season. I think, well, shouldn't people have been doing this anyway? I mean, we didn't know DeepSeek was going to come out, but you have all these big companies at high valuations set to report. One of them is going to surprise to the downside, I would assume.
So yes, the answer to that question is they've been doing both. So in VIX options specifically, I kind of mentioned we've been seeing a huge pickup in call buying, and option volumes this month has been really exceeding last year's record. We're also seeing a lot of interest in single stock options. So if you are interested in protecting against earnings, protecting against a catalyst like today, single stock options is where you want to be, and single stock volatility, trading near record versus index is a sign that people have been doing that.
When you look at some of the call and put transactions, I should say, on some of these single stocks, are you seeing people hedge by selling calls or are they buying puts?
It depends on the names. I think it's hard to say, without more broadly speaking. But in a name like NVIDIA, for example, you're seeing both. And I think in a day like today, much more on the put side. So skew has steepened much more significantly in NVIDIA, for example.
But to Romain's point, we did have a story on the terminal that said that we're seeing some selling vol rather than buying vol. So like getting interested in doing that again, particularly in options ahead of the Fed on Wednesday.
So again, it depends on the underlying, the tenor. I would say in VIX options, the theme has been actually buying of upside calls for a hedge. Now, if you look at S&P options, we are seeing a lot of people still using index options for income. So you do get that diversity of user base, the diversity of use cases. So it really just depends on what you're looking at.
So can you give us a sense then of, amazingly enough, like there's another big event this week and that's going to be the Fed on Wednesday. Yes. Are investors positioning for something or are we just kind of looking at March, for example?
So that's a good question, and something we highlighted this week is if you look at rates volatility, right, because that's what everyone's looking for, expectations for Fed. If you look at the MOVE index, which is a commonly used metric for rates volatility, that's near the lows. But I think part of the reason why the MOVE index is at the lows is driven by the front end of the yield curve. People are there's expectation that Fed's near the end of the cutting cycle. But if you look at the back end of the yield curve, right, longer dated bonds where the volatility is really driven by uncertainty over the inflation outlook, the growth outlook, volatility there is still very elevated. So rates vol index, VIX TLT, which is exposed to the back end of the yield curve, that's actually near the highs. We're not near the high, but 75th percentile high. So that divergence kind of tells you the uncertainty right now is really in the longer term outlook, the inflation outlook, whereas in terms of what the Fed's going to do, I think the market's pretty complacent about it.
Is there any sort of way to sort of assess whether we're seeing anyone out there buying and selling based on the political and geopolitical concerns?
Sure. I would say, obviously, with the new administration, that's been a very hot topic. What's interesting is that the way that most investors that I've spoken to have been playing potential impact of Trump policy, particularly around tariffs, is still by making stock-specific or sector-specific bets. So back to the theme I talked about high dispersion and elevated dispersion. That's a theme that a lot of people are pressing, even though it's at extended levels. To me, the concern, and what I'm concerned with, is that tariffs ultimately end up having more of a macroeconomic impact. So it's not just hitting specific sectors, specific companies, but ultimately hitting the consumer, and U.S. consumer making up 70% of GDP. That's going to have a big macro impact. So if you get something like that, then it will turn away from being a idiosyncratic factor into more of a macro factor, and that could have a big impact on volatility and on the market more broadly.
Is the read on that, though? I mean, even if you're a technical trader, is the read on that coming through the economic data, or is it coming through Fed messaging, or is it coming through Trump on Truth Social and whatever policies he's putting out there?
I think everyone has. I think Trump is probably top of everyone's terminal in terms of following what's coming out of the administration, certainly. But yes, I would say Trump and then the Fed are kind of the two.
All right, Mandy, always insightful. Always appreciate you stopping by. Mandy Xu, head of derivatives market intelligence over at CBOE. A closer look here at the volatility out there on the day. And if you're looking for some upside surprises here, take a look at Estée Lauder. The share is up about 1%. This after a report crossing the wire that Evercore is now working with Estée Lauder on a review of the company's portfolio of beauty brands. Alex, this according to people with knowledge of the matter who spoke to our Bloomberg reporters.
I mean, this flies in the face of my invest in your face thesis that I love to talk about. Apparently, it's been losing market share on its home turf to rivals like L'Oreal. And of course, Estée Lauder is Clinique, Smashbox, Tom Ford, Aveda, and apparently they're just losing that market share and they need to find a way to pick it back up.
And of course, there was a lot of issues, of course, with China, and they obviously that they relied a lot on travelers, on airport sales and other things where travelers would pick up things. And of course, that's been affected as well. Something to keep an eye on here. But if you're looking for a bright spot in a decidedly down day, check out Estée Lauder, up about 1% here as we continue to monitor the sell-off, counting you down to the close. A conversation with one of the most familiar faces in finance, Bob Diamond, founding partner over at Atlas Merchant Capital.
Plus, will DeepSeek chip away at America's lead in the global AI race? I've been mispronouncing that all day. As the semiconductor index, the stocks, slides about 10%. We're going to talk multiple chips with an analyst about the broader implications to the sector.
A bit of a tongue twister day here, but a focus on what is going on down in Washington, particularly with the AI race, and a conversation with with Libby Cantrill, managing director and head of public policy over at Pimco. A lot of great guests coming up. Don't go anywhere. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations, and a lot's moving out there other than tech. We're actually going to start with Qorvo. This is an Apple supplier. The wireless chip maker gets about 40% of its revenue from the company. It got an upgrade today to overweight at Piper Sandler. This comes after activist investor Starboard amassed an almost 8% stake in the company. Piper says this could set Qorvo up for improved fundamentals and could see as much as $300 million in operating efficiencies. Nevertheless, the share is down on the day. Next up, Take-Two, upgraded to buy at UBS. The analysts expecting the highly anticipated release of Grand Theft Auto 6 to drive sentiment similar to the stock's historical outperformance ahead of major releases. He expects bookings, profits, and free cash flow to reach an inflection point over the next 2 years. Shares up 1.5%. And finally, Plug Power. Seaport Global pulling the plug on the green hydrogen company with a downgrade to sell. Escalating headwinds suggesting the worst isn't over, says the analyst, who sees risks from political uncertainties that could impact government funding and top-line earnings growth. The price target set at a street low, $1 a share. Those shares down 7% on the day to $194. And those are some of our top calls. Now, we do want to return to the main story of the day, and that is the massive sell-off in tech led by NVIDIA. Our next guest is encouraging investors to keep calm, take deep breaths, and most important, maybe buy the dip. Joining us now for his insights is Antoine Chkaiban, technology infrastructure analyst over at New Street Research. And Antoine, first, put this into perspective for us, because there was a lot of talk about DeepSeek, the fact that it's been around for a year, the fact that it had released a model a year ago. It seems like you had two releases, one that was in late December, another that was in early January. This seems to have finally been catching the attention of investors here in the U.S. Can you help explain to us why?
Yes, thanks a lot for having me. So I would say DeepSeek is a group of exceptionally talented individuals doing a lot with very little, and that resulted in very impressive efficiency. That being said, I would say two things. First, this fits our broader framework on model optimization. So on one hand, you have the cutting edge and frontier models, like the ones deployed by OpenAI, whose primary focus is to unlock groundbreaking capabilities. And on the other hand, you have smaller players like DeepSeek, who innovate at the lagging edge and find ways to replicate advanced features with far less compute. But there is nothing outside of the ordinary here. Mistral, for example, also introduced a much cheaper model in 2023. And then frontier players also optimize their own models to remain competitive. And all this has a net positive impact on end demand. This is the Moore's law of generative AI. Every time the cost of transistors came down 2x, we ended up buying more than 2x more transistors. And the same dynamic will most likely play out with generative AI. Then second, efficiency is all about trade-offs. So DeepSeek is more specialized. It is trained on less data with smaller specialized experts, while the latter is a frontier world model, seeking to widen as much as possible its scope of knowledge and its ability to address any question. And V3 that was deeply focused on math and science in its training, which explained its ability to do better at math and science tests and its poor performance in general knowledge. So bottom line here is that there's nothing fundamentally new here, just a continuation of trends. So I would definitely buy the dip here.
Antoine, two things that stand out. Eventually, chips are going to lose their pricing power. And now we have more risk of, say, export controls in relation to China. How do you factor in those two?
So I would say, first of all, today China represents, so historically it represented around 20% of NVIDIA's data center revenues. Now the company has reported that it's well below historical levels. In the context of the company growing revenues in the mid to high teens sequentially. So at the end of the day, if China gets out of NVIDIA's data center revenues, it wouldn't be like a killer for growth over multiple quarters. So that's the first thing to take into account. And then if you look at data center build out over coming years, I mean, there are so many data points that we can use to build our conviction that NVIDIA is still going to grow significantly over coming years. I mean, take AMD's guide, the $500 billion spend on data center AI silicon in 2028. Take Broadcom's SAM suggesting that hyperscalers will each build 1 million XPU clusters over coming years. And by the way, that aligns very well with the Stargate plans. The Stargate plan to invest $500 billion over the next few years.
Yeah. Antoine, I just want to ask you a quick question before we run out of time here. And this has to do with the chip sides of this. And I am curious. I know we don't know a great deal about how DeepSeek got to where it was, but they're claiming that they're using less powerful chips. Is there any sense here that other companies would gravitate away from the high-end chips that NVIDIA makes to less powerful chips?
So I definitely don't think that we're headed into a world where we will use less powerful chips. And the reason for that is simply AI scaling. When you look at OpenAI's recent advancements with O3 and Chain of Thought, that really mark a real breakthrough. These models not only excel in traditional benchmarks, but they also show an unprecedented ability to generalize. In order to achieve that, you need the most advanced chips with like significant HBM coupled with very advanced CPUs. And all that, means that it's not by going to smaller chips that we're going to move to better models. So yes, I would say I really don't buy that thesis at all.
Antoine, we have to leave it there, but thank you so very much. We appreciate it. Antoine Chkaiban over at New Street Research, definitely positive on those chip stocks. Coming up, how today's sell-off is impacting the idea of U.S. exceptionalism. Bob Diamond will join us. This is Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Looks to be a very ugly close as well. The S&P is still up by about 1.7%. Obviously, the NASDAQ 100 up by 3.3%. You know it's only down 0.2.
What's that?
Equal weighted index for the S&P. Clearly relegated to tech.
Well, you take a look. I mean, healthcare stocks are up. Consumer stocks are up. I was trying to look to see where the bright spots were. American Waterworks, that's your number one percentage performer in the S&P today. But there's another company that's actually doing pretty well today, and that was Apple.
Right, go figure.
Yeah.
And I wonder if that's also a part of, hey, if ChatGPT or AI gets cheaper, is that good for then your phone when you get AI on your phone? Is it easier and cheaper?
Yeah, I'll never get AI on my phone, but yeah, in theory, I understand where you're going for. No, you have to opt into it. I haven't opted into it yet.
Okay, all right,
I'm chicken.
Okay,
Yeah,
no, fair enough.
sorry.
No, me too. But what's also interesting too is the broader sense of, do you buy the dip or is this the beginning of a bigger correction? Here with more on all of this and what it means for the industry as a whole in Wall Street's Bob Diamond, founding partner and CEO at Atlas Merchant Capital. Bob, great to see you.
Alex, great to be here. Romaine, how are you?
So I know that AI isn't your jam in particular, but my question I've been kind of thinking about all day is the U.S. exceptionalism trade, buy stocks, sell bonds, buy dollar, or buy bonds, depending on where you sit. Does that go away if the AI trade goes away?
Well, I don't think the AI trade is going to go away. I think, in my view, we don't know a lot yet about the details, but if this is a competitive, efficient, less expensive alternative, I think it's good for business. I think of our focus being on the consolidation that's happening and going to happen for regional and community banks, which is very, very exciting. All of them need more technology. All of them are looking at various methods of AI. And if in fact this is brings in a very efficient, less expensive alternative, and if it brings in more competition, I think for businesses, not for NVIDIA or the companies, but for businesses, this is really good.
I wonder about that because in terms of the CEO confidence, we're going to see lots of M&A, the capital markets are going to be wide open. But if we see this AI route spread and or continue, does that dent, say, someone like yours optimism?
I think right now this is a correction. It's all you can say. Someone asked me earlier today, will this trigger a rout in the stock market? And kind of my answer is only if there was a rout waiting to happen. I think this is very much around AI and around the valuations. I think it's a correction at this point, and I think the fundamentals for AI are improved if there are alternatives and if there is competition.
Well, that's one interesting thing about this sell-off. It is somewhat confined. It is a broad-based sell-off, but you're not necessarily seeing kind of the non-tech players get too dragged into this. Is that a sign of a relatively healthy market?
I think the market's healthy. I think, one of the things that we forget, going through the inauguration, watching the press from Davos, is the economy's in pretty good shape, Roman, right,
Yeah.
Romaine? It's the threes and the fours are great. 3% GDP, 3% inflation. I think unemployment's 4.1%, which in essence is full employment. So we have a pretty good economy right now. And I think, to me, from the areas we focus in investing, I think the change in the attitude toward deregulation is probably the single most important thing for business owners and family offices and family businesses and small businesses.
Well, talk a little bit more about those places that you are investing, because when I hear great economy, when I hear deregulation or more business-friendly policies coming out of Washington, I think what's in your portfolio stands to directly benefit from that.
Yeah, and I think, this is a bit of a soundbite, so I apologize, but it's one of my favorite sound bites, so it's fully advertised. But There is a document in government which is called the Code of Federal Regulation. It is 180,000 pages. 180,000 pages. We've just been through 4 years of Gary Gensler and Elizabeth Warren blocking logical technology approvals, blocking logical consolidation, coming out not necessarily positive on bank consolidation. And just to put that in perspective, they were kind of worried about the big four in consolidation in banking. And yet we have 4,500 regional and community banks that are incredibly important to our economy, to small businesses, to medium-sized businesses, and consolidation will make them stronger. So we should really be excited about this opportunity if we're looking for more competition and more depth in financial services. And we're very confident that the attitude toward approving logical transactions or transactions that are good for banking and good for competition will be approved.
Hence the animal spirits, hence the U.S. exceptionalism. I would definitely use ChatGPT to read that document, by the way. Do a little summary there for me.
How would you know it's right?
It's true.
You're not going to double check that.
No, I'm definitely not going to double check that. Where do you think we would see the regional tie-ups? Like, is it defense? Is it offense? Is it regional? Is it, is it based on location? What do you see?
Well, I think there is a location aspect, particularly when consolidation is at its most successful when it's about cost synergies. So I think acquisitions that happen within state make a lot of sense. Alex, if you think about it, there's 4,500 banks in the U.S. That's probably too many. And I think one of the impacts, or one of the after impacts of the failure of SVB and First Republic was the regulators were very, very focused on the smaller, typically private community banks, which for decade after decade after decade have had 10 to 15 to 15 to 20% return on equity. With the intrusion from the regulators and the focus on investing in compliance, investing in technology, so many of them today are just too small to succeed. And so our approach is to invest in regional banks that we think have very strong leadership, very strong profitability, need more capital to kind of shore up, the capital ratios, of course, stay below that 100,000 level, which triggers more capital. And then look for opportunities to acquire the smaller, too small to succeed institutions where the combination will be good for both. And the synergies are really about costs, technology, compliance, regulation, and it will make them stronger.
Where does DEI fit into that now? I feel like if you were looking for good mergers, your view on DEI would be very different now than it is, say, a few years ago. True?
Well, I think what you have seen and I have seen since the inauguration is just a very, very different attitude toward the priority of that. But I think in terms of the boards of the kinds of institutions we're looking at, I think they're in far better shape from a DEI point of view today than they were 5 years ago, 10 years ago, 15 years ago. So I think we're starting out from a position of strength.
All right, Bob, always great to have you. Bob Diamond here, of course, founding partner and CEO of Atlas Merchant Capital. A closer look here. Some of the other trades out there that aren't necessarily AI, but we go back to that when we come back after the break with a closer focus on the hyperscalers, taking a bit of a hit, not quite as big as the chip makers. We're going to break down, I guess, what's ailing them, and more importantly, could this be a turnaround in the future? That's our Stock of the Hour, and it's coming up next right here on The Close on Bloomberg. All right, it's time now for our Stock of the Hour, and today we will have a sector of the hour. Investor concerns over DeepSeek's cheap AI model taking a toll on the hyperscalers. That includes Microsoft, that includes Amazon, and in a big way, it includes Oracle. Anurag Rana joining us right now, senior tech analyst at Bloomberg Intelligence. And Anurag, let's start off here with the downdraft that we're seeing in these names. And what's driving that? I mean, wouldn't this lower the costs for Microsoft and Oracle and some of these other companies, or am I just kind of misinterpreting it?
No, I mean, you were absolutely right on that. I mean, as far as Microsoft and Amazon is concerned, in the long run, something like this is good for them. But I think people were associating Microsoft and OpenAI together because Microsoft does provide the infrastructure for OpenAI workloads. But one of the most important things that people may not know that Microsoft's revenue that it generates on AI, a large portion of that comes from inferencing, which is when you are using the application and whatever the results come out of it, and not so much from the training part of it, because that's kind of the deal they have with OpenAI. I think the big drop here is on Oracle because, as we know, Oracle is not at the same par as in terms of the market share when it comes to cloud infrastructure as Amazon Web Services or Microsoft or Google. It's much down in the order, and the contract they were going to get to build a very large data center, or that the announcement that was made a few days ago had the potential to significantly increase their market share in that. Now, the big question is, do we still need to spend $500 billion to come up with data centers across the country? I think that is the big question at this point. And that's the reason why Oracle is getting far bigger hit than the likes of Amazon and Microsoft.
Anurag, flip it for me, because some of the software guys like Workday and Salesforce outperforming. Why?
Yeah, it's the exact same thing that Romain mentioned. If the cost of running these transactions goes down, then the adoption curves goes up. So, for example, Microsoft's Office Copilot. This product was being sold at $30 per user per month, and it didn't have, in our view, that much of an adoption. They changed the pricing to a consumption pricing just to get people used to it. But imagine that product going down the cost curve quite a bit. Let's say, for the sake of discussion, $5 to $7 of what they charge for Teams at this point, extra, compared to their base package. That would really help adoption. So I think what you're seeing in the software world is somebody like a Salesforce. If the cost of transaction goes down for them, then you will see more people use their AI enhancements. Same thing for ServiceNow, same thing for Adobe, etc.
Just curious, Anurag, when we start to get these conference calls, Microsoft this week, I think Amazon maybe the week or two out, do you think that they're going to address this head on, what we learned today about DeepSeek?
Oh, they better. I mean, this is going to be the most important question on every tech call going forward as to, does that change your CapEx requirements? Does that change your margin structure down the road? And what would it do to adoption? I think this would probably be the central question for all conference calls going forward.
Hey, Anurag, really appreciate it. Always good to catch up with you. Anurag Rana, one of the best over at Bloomberg Intelligence. Thank you very much. Now, continuing on the AI theme, the second derivative of what's getting hit are energy stocks. You're looking at Vistra, worst performing stock in the S&P, GE Vernova, Constellation Energy. These are all the power players that were going to provide power for the data centers. They're getting hit really hard, which is so interesting, Romain, because typically utilities do well in a sell-off.
And I was also interested in a lot of the infrastructure, meaning like the electricity and power infrastructure companies. Eaton having an awful day. It was down 15%. It's like the worst day since like 87. You had a lot of other names, Amphenol and a few others as well, getting caught up in all this. I mean, you look at these numbers here and you look at NVIDIA, it's almost like everyone's just saying, okay, AI is over and we're moving on. Is that the case?
Baby in bathwater. No, you actually have Evercore ISI have a note out on these power guys saying that the magnitude of these share declines implies any uplift provided by the promise of data center load growth has been washed out. So again, AI or bust at the end of the day.
Absolutely.
All right, we're about 15 minutes to the close of trading. It is a brutal day if you're a tech investor. The Dow is up and you have the equal weighted index also pretty much flat on the day. Lori Calvasina will help us take us through the close. This is Bloomberg.
These existential questions tend to come up from time to time. That's what's happening today with NVIDIA. I think, there are plenty of near-term questions that these companies are going to have to address during earnings this week, but I still am a holder of NVIDIA long-term.
John Belton over at the Gabelli Funds talking about his holdings of NVIDIA. That stock down at least 17% right now as we head towards the close. The main drag on the broader indices, including the NASDAQ 100 and the S&P.
But if you have any sort of, if you want to look at, if it's just tech, just look at the equal weighted index. I mean, that's pretty much flat on the day. But this board is showing you that chip pain. I mean, the SOX index looking at its worst day since March of 2020. That was shutdown time.
Yeah, and I saw this. I mean, so we had like an open like 6% lower. I think at one point it was down 10%, and now basically down 9 or 10% here. So this idea here of what is being sold, and I think you used the word baby with the bathwater during our last segment, that kind of appears to be this. I mean, it's not to say that DeepSeek does not potentially pose a risk to some of these companies, but 10% on the index level, 20% on the individual stock level?
Yeah, you have, yes, baby bathwater. Also, I wonder what would have happened if we didn't have big tech earnings this week. Will we have a different kind of flavor here? And also just the valuation was so high and it was so crowded that you have to wonder if also funds are kind of moving things around at this point.
Yeah, well, let's bring that up with our next guest, Lori Calvasina, joining us right now to continue counting us down to the close, head of U.S. equity strategy with RBC Capital Markets. And I do want to start with this earnings week, if you will, because I was looking at your weekly note, which I assume was probably written before some of this DeepSeek stuff came out. But you kind of talk about this has been a relatively solid earnings season so far. You also quote all of these commentaries that we've gotten from the conference calls, and I couldn't help but notice that a lot of those quotes from these executives included AI in some form or another. Based on what we learned today publicly about DeepSeek, does that change the narrative for you at all, or is this just kind of a one-off thing and the overall arching narrative is still the same?
It's a great question, Romain, and I'll be honest with you. In last week's earnings, my team and I were joking. We didn't feel like we learned a lot of new information. There was more AI commentary that came out last week than the prior week, which was very heavy in financials, and that's somewhat interesting in and of itself. But I think that we're really on the cusp of getting this deluge of earnings reports from companies later this week and next week, and that's when we're really going to start to learn some things. So, I've had my thinking hat on today. We have been watching the market action, but I wouldn't really overreact to one day. I think the problem that we've had, if you go back the last few quarters, maybe even the past year, frankly, is that we keep going into these reporting seasons, and there's all this angst around the AI trade, and people look at the Mag 7 and they say, well, the valuations are extremely high, and there's really been this itch to rotate. And so we get the financials and things look pretty good, and it feels like we're ready for this rotation. And then we go in, and usually there's like one or two of these big tech companies that disappoints a little bit. There's some volatility. Maybe some of the others are stronger. We go to post-reporting season. The analysts go back to their desk, update their models. They've usually talked to the companies, and magically we see some resilience in those big tech names. And so you've had this deceleration in earnings growth anticipated for the big tech companies, kind of that Mag 7 cohort, but they keep fighting back. And so to me, this is just sort of a chapter in that longer saga that we've been going through for a year. Admittedly, a more exciting chapter, but I don't know that it's terribly different to me yet.
Well, let me just cherry pick one, and I know you can't go too deep into single stocks, but I just want to use Meta as an example because they pre-announced last week about their CapEx spend, and for one reason or another, the market reaction to that was decidedly positive. It's up again today, 6 straight days of gains for that stock. And I do wonder, once we start to get the earnings out of Microsoft and some of the other big spenders in the AI space, are you concerned at all about the CapEx spend, at least of what we know publicly now?
Look, obviously, Romain, I can't go into any single name, or the compliance gods are going to zap me with a bolt of lightning. But the reality is that the premium valuations in this Mag 7 cohort, we actually expanded a little bit and look at the top 10 market cap names in the S&P 500. But if you look at that relative valuation, that median PE of that basket against the median PE against the rest of the market, it is an extremely extended relative valuation. But if you overlay long-term earnings growth expectations on top of it, the two lines are basically moving together. So those valuations are very much dependent on those longer-term superior earnings growth outlook. And I think that's really what's been called into question to some extent today. We will get more color from these companies. But I think, there's short-term earnings. There's how does 25 and 26 look? How does the current quarter look? But I think at the end of the day, it's really that longer-term earnings outlook picture that dictates things. And I don't know that I think we have some doubts that emerged on that today for this broader cohort, but I don't think we have a definitive answer yet. And we're about to hear from a lot of companies that are going to weigh in.
Oh, yeah. So, Lori, what's the safe haven play? Usually it's utilities, but a lot of utilities are in the power sector related to AI. What's my safe haven?
Now, it's interesting. I mean, we've watched the market action today. You're seeing strength in healthcare. You're seeing strength in financials. I will say that the financials are probably the more interesting to me out of those two buckets. We, again, got through a very good reporting. Maybe it's not completely done yet, but what we've heard so far has, sounded very, very good. We think financials valuations, they don't look fantastic, but they still do have some room to run. I think banks look better than, say, capital markets names, which maybe look a little bit pricier. But in general, I think financials just need the economy to keep on chugging. They're not really at the epicenter of a lot of the political debates that are happening this year. And so that's a reason why we've been able to forgive some of the more extended, kind of slightly overvalued absolute valuations, because you don't have those political headwinds coming and you've still got pretty reasonable relative valuations that have some move to go. Yeah. So I like that sector today.
Yeah, and if anything, they have deregulation that's going to be a help to them and a catalyst. Small caps, before we let you go, down over 1%. Not the worst if you're looking at, say, what's happening with tech, but nonetheless, when do we buy?
So, look, I think small caps, you really do have to watch the valuations. They were actually up a little bit in the morning. They were in the green. Now they've moved into the red. We basically got to a crowded, overvalued position in small cap post-election. You actually had seen the crowding return before the election. We were at, back to the 2016 type highs on CFTC data. We've since pulled above those. You got back to those kind of Trump first term type valuation peaks post-election in the Russell. We've got to let that play out. Your long-term average valuation is around 15 times. With us getting to the end of the Fed cutting cycle, I think there's still probably some headwinds there. But I think, we've certainly gotten closer there over the last month or so.
Lori, we'll let you get back to work. Always appreciate you taking time for us. Lori Calvasina, head of U.S. equity strategy over at RBC Capital, counting us down to those closing bells, just about 2.5 minutes away. A modest bid, believe it or not, Alex, coming into the market. The Nasdaq still down 3%, but off the lows of the day.
Off the lows, S&P also off the lows. I'm interested to see if volatility continues higher, because it was lower, therefore volatility funds had to buy. If volatility spikes, they have to sell. And if we continue to see that sort of rotate tomorrow. And we should point out, this is going to be a really busy week for market catalysts. Obviously, a lot of big earnings. Don't forget, we have a Fed meeting. Do you remember that? What? No.
And inflation data on Friday here, so the markets have a lot to chew on. We're going to break down all of today's market action piece by piece as we head to those closing bells with our global simulcast. Starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through that closing bell. A global simulcast starts right now with all of us. Yeah, you just saw it. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth. I would call this a historic record day, Carol Masser, but the NASDAQ 100 down 3%, worst day since December.
Okay, yeah. I mean, a little perspective, right? Isn't that what we do really well, is put it into perspective? I mean, I keep looking at the major equity averages. I mean, you still have almost 350 names in the S&P 500 that are actually up today. Even the NASDAQ 100, more names are up than down. So I just think it's very targeted, it's very specific, and I think there's a lot of questions about what this news really means in terms of the AI investment play going forward.
Well, if you want to see where things are getting hit, one of the areas is the stocks, down more than 9% right now. 27 of the 30 stocks that are in the stocks lower today. Yes, including Broadcom, Nvidia, and Marvell, which are all down double digits.
Yeah, but doesn't this make the earnings calls that we're going to get later on this week a lot more interesting?
Yeah.
Especially with Meta pre-announcing how much it's going to spend on CapEx. You're going to have a lot more interested people listening for hundreds of billions of dollars, and whether that still makes sense.
I know. Usually I just kind of wait to read the transcripts, but I'm going to get on these calls now.
We're going to get excited. I do want to point out, though, guys, that commodities are still getting hit pretty much across the board. That feels like you sell what you can, not what you want things. So I appreciate that in the equity market, maybe we're sort of like it's just a tech story, but the follow-through selling there is something.
Well, I'm glad you brought up commodities, too. We kind of forget all the other news flow. Apparently, we were at war with Colombia or something over the weekend.
Like 24-hour
which sent coffee
war,
prices up and sent soybeans and other down. And then, of course, some bad data out of China here. Nevertheless, let's just say this could have been a lot worse, folks. We're going to start with the S&P 500 as we get the closing bells. The S&P is still holding that 6,000 level. It is down, though, almost 90 points on the day, or about 1.4%. The NASDAQ composite is down more than 600 points, or 3%. The NASDAQ 100 also roughly down about 646 points, or 3%. If you're looking for a bright spot, there are a couple places you're going to find it. The Dow Jones Industrial Average up 289 points, or roughly about 0.6%. Dow Transports up 242 points, or about 1.5%. And you see the Russell 2000 on the left of your screen there. That did finish the day down by about 1%, but I challenge you, pull it up on your Bloomberg terminal and see what rose and what fell, and you'll get a better sense of market sentiment.
Yeah, so perfect setup going back to the S&P 500, 351 names to the upside in the Monday trade, 152 to the downside. And Scarlett, if you look at the NASDAQ 100, 55 names higher, 46 lower.
Yeah, but there are some big swings in the sectors that mattered here. And let's start with the obvious, which is tech. And it's the biggest slice of the pie, of course, because it's the heaviest weighted sector in the S&P 500. That group losing more than 5.5%. Utilities, as Alex mentioned, down by more than 2%. That, of course, they're the second derivative play of the AI story. But you look at the big gainers here, and your traditional defensive sectors like consumer staples and healthcare. Lori Calvasina of RBC just mentioned financials as a safe haven as well. Each of those group gaining at least 1%.
All right, let's get to some of the individual gainers. Apple, check it out, folks. Reporting on Thursday, outperforming the broader trade in a big way, up about 3.25%. It's the number 4 gainer in the NASDAQ 100 today against that broader sell-off of the NASDAQ 100 and against its own recent weakness. Keep in mind that this one's been under pressure. Apple's down about 10% since late December. Our team noting that while Apple is expected to be a long-term beneficiary of artificial intelligence, especially as its millions of users access AI services through the iPhone and other hardware, it hasn't been devoting billions of dollars to AI capex the way other mega caps have. So maybe a little bit of a rethink, but definitely an outperformer. I want to go to the ADRs of Aurora Mobile. It's a micro cap, small company, $115 million market cap of those ADRs that trade here in the United States. It's a Chinese software and application company, up 141% after it said its enterprise AI platform has incorporated the DeepSeek R1 large language model. So kind of on the coattails of all that news that we got about DeepSeek in today's session. And then just for something different, Vail Resorts, finishing off its highs, but still a gain of about 5.5%. This company was issued a letter from its shareholder, Late Apex Partners, calling the company's performance unacceptable and says Vail must replace both its CEO and its CFO, reset its board of directors, and cut its dividend by 80%. So that one saw a fair amount of activity.
Can I just also add AT&T?
I know.
Isn't that amazing?
Yeah, I mean, best day in more than a year on the back of, I guess, what were some pretty decent earnings, Carol.
It was a very different trade today.
And a little safety play there.
Yeah, exactly.
All right, let's go to what everybody wants to talk about. Shares of NVIDIA today, the biggest decline, I should say, going back to March of 2020. It erased a record amount of stock market value, $589 billion in value. Shares down about 17%. The sell-off today fueled by investor concern around the Chinese AI startup DeepSeek. The latest AI model of DeepSeek that was released last week, it's widely seen as competitive with those from OpenAI and Meta platforms. Apple, for what it's worth, now back to the world's most valuable company after today's decline. NVIDIA coming out and saying that DeepSeek is, quote, an excellent AI advancement that complies with U.S. technology export controls. We also saw other companies in the space fall as a result of this news. Broadcom down 17.4% today. It's a key ingredient, of course, in the companies that are designing their own chips. So think Amazon, think Alphabet. So if there's perhaps less need for those, then Broadcom is affected. Once again, shares of Broadcom down double digits today by 17.4%. And finally, the worst performing stock in the S&P 500 today, Vistra Corp, down 28%. Because if you have less of a need for those hyperscale facilities, then you have less of a need for power. And that's why independent power producers got absolutely crushed today. It was actually the best performer in the S&P 500 last year, up more than 260%, but down today by more than 28%.
Yeah, Romain and I were talking about that earlier, like baby with the bathwater. Like, is that what we're looking at here when it comes to all those derivative plays? Looking at the bond market, it's been a solid bid the whole day across the curve, yet yields are off the lows of the session. Just taking a look, say, at the 10-year, yields ending down by about 9 basis points. At one point, they were off by about 13 basis points. We also got a 2- and 5-year auction. They were fine. Tomorrow, we get the 7-year auction, so watch that as well. The 5-year did pretty well today.
All right, I had mentioned earlier that this is a big week in terms of tech earnings. Which one are you guys looking forward to the most? Because it feels like Meta kind of front run their whole CapEx spending. We already know what the number is going to be, but now the onus is on Microsoft to see whether they do anything.
Okay, so on Meta Platforms real quick, I was surprised to see the stock reaction to this announcement late last week, because normally when you see a CapEx announcement go higher, the stock gets hit, but investors were bullish on this. And we also saw Meta Platforms, at one point it was down today, later in the day it was higher. Investors not selling off the stock today as a result of what we saw from DeepSeek. Do they come out? I mean, Mark Zuckerberg knew about this last week, even with the announcement of increased CapEx spend. Do we see any of these companies pull back?
Well, that's what I'm curious about. I mean, I guess the short answer would seem to be probably no. And I thought you brought up a good point, is a lot of people were talking about this idea that there's no way that these tech CEOs and the other folks beneath them weren't already aware of what DeepSeek was capable of. Like I said, this kind of dates back to late December and then, of course, back to January 9th. As far as what I'm most interested in, to answer Scarlett's question, I kind of want to hear what Apple has to say. Because they were kind of the laggards in this, right? They were the ones everybody said, well, they're behind the curve. Why aren't they spending more money? Why aren't they articulating more of a AI strategy? And I don't know. I kind of feel like, for a variety of reasons, maybe it's kind of better that they didn't.
Well, maybe, but also they just hired a new head of AI, right? So interesting to see sort of the read-through on that. But to your point about CapEx spend, so it feels like 2026 is now what we care about in terms of CapEx spend for these companies. Remember, for Meta in particular, they have Meta Llama, which is open source, right? So something that's open source that's doing really well, it's easily adopted, should be good then a read-through for Meta.
Well, that's the thing that's interesting, right? That if this ultimately is true, and there's still a lot of questions in terms of, their developments, DeepSeek and what they found out, and the cost side of that equation. But if it is a lot cheaper, anybody who's been doing the spend, and I will want to know from Meta that, do you rethink your spend? That if it's not, you're not going to have to spend the $65 billion. So I do think that it could be a plus for the likes of Meta and Apple, that when they ultimately do, it's going to be a lot cheaper on their CapEx line.
There's also a big question mark about how Washington responds, or whether it responds, because clearly the export controls may have been working, but China was able to get around that and use the lower end chips from NVIDIA to create all of this.
So that should be a concern to NVIDIA, right?
Yeah.
That its most recent highest end chip wasn't the one necessary to make a product such as this.
Yeah, and I'm also on that same front, though. I also am curious to hear, too. We're going to get some earnings out of the car makers. I think GM, of course, Tesla as well. And we also talk about some of these chips and just the technology, the AI technology being used, of course, with autonomous and assisted driving and other things like that. So we could actually get some interesting commentary out of those companies as well.
It's only Monday, guys. Unbelievable.
Is it? Are you sure?
It is only Monday.
Yeah.
Sorry. All right, guys.
But it's not bad. It's going to be exciting tomorrow, unless you have to go to a municipal bond conference.
Which I'm looking forward to from 10 to 12. So listen in on radio.
Okay, we will. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, folks. We call it the closing bell. We'll see you again, same time, same place tomorrow.
And we continue our full and special coverage of the sell-off in markets, a conversation up ahead about the longer-term implications of the sell-off on the broader chip sector. Chip whiz Stacy Rasgon going to be joining us, senior analyst over at Bernstein Research. Stick around. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another wild day on Wall Street, but not quite for the reasons I think we thought, right? DeepSeek, a company that I think a lot of people had never even heard of prior to this morning, really did rattle the markets, but it really could have been a lot worse. Take a look at the screen behind me. The S&P 500 down 1.5%. That's awful. That's the worst day since early January. The NASDAQ 100 having its worst day since December. Now, when we narrow it down into, say, chip stocks specifically, that's where things look a little bit more murky. The Philadelphia Semiconductor Index dropping 9% for its worst day since 2020. And this is a big part of the story, Scarlett, because we talk about this idea of whether the AI trade is over. I don't think anyone's saying that, but maybe valuations got a little bit out of control, and maybe that's a big part of the reason we saw that downdraft in NVIDIA.
Yeah, people perhaps rethinking, reassessing the AI trade, at least for today. And NVIDIA, of course, is at the center of the AI trade, down down today by 17%, but at one point it did plunge as much as 18%. Now, the problem with being the undisputed king, the winner in the AI race, is when there's a disruptor in that race, that winner has the most to lose. And in this case, NVIDIA lost about $589 billion in market cap today alone. However, there were some winners in the software space. Salesforce.com and ServiceNow, each gaining, as you can see there. Barclays says that these firms offer AI services that should benefit from cheaper AI models. And in the old economy space, KB Home, the home builder, up almost 5% on the day, getting a boost after a report showed that new home sales rose more than expected in the month of December. But our top story this hour, certainly going back to the tech space, risk off for AI stocks, because as much as the rise of China's DeepSeek took investors by surprise, concerns about lofty valuations, they've been circulating for weeks. The Nasdaq 100 trades at 27 times estimated earnings, well above its one decade average, led by NVIDIA's 30 times forward PE. Now, in the end, this may have been a sell-off in search of a catalyst, and DeepSeek happened to provide a convenient spark. We're going to take a look at where this leaves the semiconductor industry, as well as companies at the forefront of developing AI applications.
Yeah, we talk about that Philadelphia Semiconductor Index having its worst day since 2020, of course, led by NVIDIA, Broadcom, and a few others. But our next guest weighing in, saying that overall, our own reaction is not to buy into these doomsday scenarios playing out. We continue to like the AI stories in our coverage, particularly NVIDIA and Broadcom. Stacy Rasgon joining us right now. He's senior analyst of U.S. semiconductors over at Bernstein Research. And Stacy, I just want to kind of lay out the narrative, because the narrative of this AI trade, at least when it came to a company like NVIDIA, was that in order sort of to create these models, create these data centers, and power all this stuff, you needed these most advanced chips that pretty much only NVIDIA was making. They could pretty much put whatever price tag you want on it. Boom, NVIDIA becomes a rock star stock. DeepSeek comes out, says, hey, we somehow find a way to do this for peanuts. I am curious if you could kind of square the circle between that past narrative with NVIDIA and this cheaper, supposedly cheaper narrative coming out of DeepSeek.
Yeah, so unfortunately, the narrative that kind of emerged like on Friday and into the weekend was kind of, hey, this Chinese company has reinvented OpenAI for $5 million, which is, if you read through the papers, that is absolutely not what they did. There's also some confusion. They had actually two families of models. They had, it was a base model called V3, and then a reasoning model, which is what's causing a lot of the angst. The V3, and by the way, both models are very good. We'll talk about that. But the V3 model was trained, it was actually trained on NVIDIA H800 chips, which are no longer legal to sell in China. They had a cluster that was there. And they trained it very efficiently, but it was trained on those. And they had a number of interesting innovations and things that, by the way, are not secrets or miracles. Everybody's working on that stuff, but they trained that. They use that as the base model to use something called reinforcement learning to create R1, which is the reasoning model that everybody's like getting all excited about. I have no idea what they used to train. They actually did not disclose the training requirements and the infrastructure that was required to train that model. So we actually don't know what they did. But I do think the idea that they spent like $5 million and duplicated everything that everybody else is spending billions on is nonsense. It's clearly not true if you read everything.
I am curious. Go ahead. Yeah. I'm sorry. Go ahead.
No, I was just going to say, like, the other things, like I said, you look at the innovation. By the way, I don't want to discount the models. The models are fantastic. Like, don't get me wrong. They really are. But if you look at the things that they did, it was a mixture of experts on the V3 base model, which enabled them to trade it like very efficiently, and a bunch of other things. None of the things that they did are secrets or miracles or are not unknown or frankly not even being used by any of the other AI labs that are out there. So,
well, that's what I'm curious about. And we should just point out for the record, I mean, DeepSeek is a legitimate company. The guy who founded it, certainly legitimate. We don't know all the details of how they arrived at what we learned today, but we do know there is legitimacy to this company. Is there legitimacy, Stacy, to the AI spend here in the U.S., the $65 billion coming out of Meta, the $100 to $500 billion potentially coming out of Stargate, and so on and so on? Is that still intact, or could we see some of these executives maybe rethink that?
Well, we'll see what happens in the near to medium term. I don't know. I mean, things are always going to be lumpy, but over the long term, I actually don't think this is a negative for that spend. As long as you believe that we are not close to the limit of the compute that we need to bring some of these AI visions into reality, which I think is true, we actually need efficiency gains. Otherwise, you'll never be able to get there. You know, I said this earlier on, I think on another, maybe on one of your sister programs, but You go back to there's a hot chips conference that happens every year in Stanford, and a couple of years ago, Bill Daly, who's NVIDIA's chief scientist, was talking, and he was talking about how they've improved GPU performance over the years. And he was talking like over the last 10 years, they improved it by something like 1,000x. So efficiency gains have been happening. And what he said is over the next 10 years, we want to improve it by another 1,000,000x. If you think about what most of these companies are trying to do and think about the amount of compute that is required, we need efficiency gains. We'll never get there otherwise. And so I actually think this is a positive. Remember, I'm a semi guy, so I'm biased, right? But I think cost reduction is a good thing, not a bad thing. And like in semis, cost got cut in half every 2 years for 5 decades. It wasn't negative for semi demand. It was massively positive.
And this is what innovation is supposed to do, right? Everyone's quoting the Jevons paradox, where efficiency gains will generate more net demand rather than less demand. So my question to you, Stacy, is DeepSeek's models winning a lot of praise, endorsement from the likes of Satya Nadella, Jensen Huang as well. Is AI now a commodity and should be priced like one? An expensive commodity, but a commodity nonetheless.
Well, this is the other thing. So DeepSeek, the other thing that's getting people very antsy is that they price. Remember, it's an open source model. You can download and use it if you have the infrastructure to run it. But they price their tokens if you were to use their API. It's something like 1/20th to 1/40th what OpenAI is pricing similar stuff for. So that's what they're pricing it. I have no idea what their economics look like. Right? So we don't actually know where the costs are like relative to everything else. So we'll have to see. But I actually do think having cheaper inference is a good thing. And what we ultimately want, what everybody's been complaining about, is they're wondering where the returns, how do you get adoption, how do you get returns on this stuff, and how do you get people to use it? My view is that a proliferation of affordable AI that's how you get like adoption and proliferation everywhere. Like again, we need it. And some of these models, again, these reasoning models use a tremendous amount, not just to train them, but to do the inference, to actually use the models requires a tremendous amount of compute.
Stacy,
so I want to see adoption. I want to see proliferation.
Final question to you. Does the existence of DeepSeek's cheaper AI models force you to look at the earnings we're going to get from Meta, from Microsoft in a different way this week?
So I don't look at Meta or Microsoft, so that's not my issue.
But even just to get a read.
Well, so what I will be looking at is their CapEx. And again, in the middle of all of this, like yesterday, last week, we saw Meta massively increase their CapEx guidance. We saw all of the talk around Stargate. We even had China announce a 1 trillion RMB. It's about 140 billion US national like AI infrastructure plan. So everybody that's out there spending the money is looking to spend more and not less. And these things that DeepSeek is that people have gotten attention now with DeepSeek, these are not secrets.
Yeah.
Like again, the V3 model was available in December, right? Like these are not secrets to anybody in the industry who are making the investment decisions. And right now they seem to be looking to spend more money, not less money.
Well said. Stacy, really appreciate your joining us today. Stacy Rasgon, Senior Analyst of U.S. Semiconductors at Bernstein Research. Coming up, we're going to stay on this DeepSeek fallout and take a deep dive into the world of AI with Deon Nicholas of Forethought Technologies next. This is The Close on Bloomberg. China's DeepSeek is an upending technology, with NVIDIA calling the startup's cheap new model an excellent AI advancement. Let's bring in now Deon Nicholas, who is president and co-founder of Forethought Technologies. It's a company that uses AI to create data-driven solutions, including things like AI agents. Deon, it's great to speak with you. I know that you have been aware of DeepSeek and you've been reading up on it. And what took you by surprise is the market's negative reaction this morning. What are investors getting wrong? What are they misunderstanding about this development?
Yeah, and thanks for having me, Scarlett. Happy to be on the show. One of the things I think investors are betting on here is that, first of all, that this DeepSeek announcement is all about efficiency. If they're able to, in theory, do what OpenAI does at a fraction of the cost, then what does that mean for all of the US-based and all of the AI giants out there? So people are expecting that a lot of the compute costs are going to come down. And then the second thing is really the geopolitics of it all, right? In the sense of you have OpenAI, you have a lot of US-based firms that are leading the race right now. What happens when other companies, other countries are starting to catch up? And so I think a lot of that is leading to the sell-off in particular stocks like NVIDIA and others. But also I think this is really just an index of how people are feeling about US-based AI stocks in general.
I am curious, though, Deon, when we talk about the response that NVIDIA gave, and they sent an email statement to Bloomberg, and maybe you could break this down for me. They say that inference, their words, requires significant numbers of their GPUs and high-performance networking, basically making the defense that one way or another, you're going to need NVIDIA's high-end GPUs. Explain what inference is.
Absolutely. I love that idea that really all roads lead to NVIDIA in some way. So a lot of the advancements in the past few years in AI and the computational power has come from training. These pre-trained models, GPT, generative pre-trained models, have taken all this data and used the compute to train so that at the time when you're actually answering a response, imagine answering a customer support inquiry or something like that, that's inference time. Usually that's pretty quick. The model's been pre-trained, so the answers come very quickly. With these reasoning models like OpenAI's O1, O3, and now DeepSeek's R1, these reasoning models are shifting some of that compute from training to when they're actually answering the questions. Instead of answering right away, they're taking a lot more time to think. And that thinking is happening by having the LLMs effectively query themselves through a technique called chain of thought. Imagine having a monologue with yourself. And that's actually where all the compute's going for this planning, this thinking process that's now producing better and better results to harder and harder problems. And so compute's no longer going to happen, or it's still going to happen at the pre-training level, but it's going to actually shift to all this inference, thinking, and reasoning, which is bringing about the AI agents craze, which I think is actually going to be really important.
What does it mean, Deon, that DeepSeek was able to do this on NVIDIA's lower-end chips, not the super high-end chips that China doesn't have access to?
Yeah, so we know, there are export controls. There are probably things that are going to be even more cracked down in terms of the new administration. I think what's going to happen, though, is a lot of people think this means that NVIDIA, you're not going to need NVIDIA chips. I think that's false. We don't know from the papers that DeepSeek published what they were training on. We know that their final run took $5 million worth to train the final model in terms of compute. But they did a lot of research behind the scenes in order to figure out the breakthroughs that led to this DeepSeek model. So I actually don't buy that they're not going to be leveraging the latest and greatest wherever they can, or that having access to the latest chips won't actually give an advantage. I think there's still a lot more upside to go there.
One thing that this episode, and more importantly, the market reaction to it, Deon, has raised is this idea about end use case, because I think that's what scared a lot of investors, that there's so much money being put on this, but where's the return? Your company's a little bit different because you're kind of focused more on the end use to a certain extent. And I am curious as to whether you're still seeing buy-in to that idea, whether it's by potential customers of Forethought or potential investors.
Yeah, I've actually never been more bullish on the application layer. So at Forethought, we're building the most advanced agentic AI for customer support. And what all of this is showing is that at the foundational model layer and at the hardware layer, there's going to be a ton more competition. The irony is that this makes the application layer better. This means you now have models that can reason, that can think. These are the very same capabilities that we need to make customer support and other application level AI more effective. So we're actually seeing more and more demand. We're already resolving billions of issues every single month. And we think that this is going to continue to trend, and that investment should actually start to happen on the application layer more so than on the foundational model layer.
All right, Deon, we have to leave it there. Always appreciate your insights, and you always make it sound, intelligent for people like me who don't really grasp these concepts that well. Deon Nicholas, he's the president and co-founder over at Forethought Technologies. As we continue our coverage of what's going to happen in the tech space today, we're going to take a closer look at, some of the government implications, and we're also going to take a look back in history at the introduction of the iPad. This is Bloomberg. All right, let's go back to this day in history. Back in 2010, when Apple CEO Steve Jobs, making his first public appearance in months amid a battle with cancer, he strode onto the stage at the Yerba Buena Center out in San Francisco wearing that trademark Issey Miyake black mock turtleneck. And instead of saving the best for last, as he normally would do, he decided less than 10 minutes into his 90-minute presentation to reveal what by then was one of the worst kept secrets out there: the introduction of the Apple iPad. A 1.5-pound, half-inch thick $500 tablet that Jobs claimed creates an entirely new category of devices. Now, it was not the first tablet. This is Apple we're talking about after all. But the iPad, it was a bit odd. In fact, It was not nearly as powerful as the old stripped-down PC tablets that Microsoft had experimented with in the year 2000, and the iPad was double the price of the black and white e-readers like the Kindle that were growing in popularity. Potential customers, they griped that the iPad had no camera, it couldn't take phone calls. Adobe complained Apple wasn't supporting its Flash video software that was used at the time on almost 75% of the websites out there. And some women took issue with the iPad's unintentional yet, well, somewhat oblivious association with certain hygiene products. Even bullish analysts like Gene Munster, who was then over at Piper Jaffray, said that Apple could manage to maybe sell just 3 or 4 million devices out of the gate if they were lucky. Well, guess what? The iPad sold 7.3 million units in the first full quarter after its release. And in the first full fiscal year, it sold more than 30 million units, generating $19 billion in revenue, or about 18% of Apple's total corporate sales. That rivaled the numbers for its Mac computers, which was generating about $21 billion in sales that year. Now, for all the success of the iPad, its launch turned into a sad footnote for Steve Jobs, who would make what ended up being his last keynote speech for a major new Apple product introduction. About a year after the event, he would take another leave of absence for health reasons, and a few months later, he passed away at the age of 56.
And of course, before he did so, he did create an entirely new category with that device, with the iPad. We do have some breaking news on earnings. Nucor, the steelmaker, coming out with results. Fourth quarter earnings per share, $1.22. That seems to beat the estimate here handedly, which was 65 cents. That was the consensus estimate. For the top line, sales was $7.08 billion. Analysts were looking for just under $6.75 billion for the quarter. So you're looking at Nucor shares currently up about 4% in after-hours trade. All right, let's go back to tech and AI and turn now to Washington, because David Sachs, the first ever AI and crypto czar for the White House, said today that President Trump was right to rescind the Biden executive order on AI safety, adding that the order hamstrung American AI companies without asking whether China would do the same. Where does the emergence of DeepSeek leave Washington? And what does it say about the restrictions that have been put in place? Joining us now to discuss is Libby Cantrill, Pimco Managing Director and Head of Public Policy. Libby, always great to see you.
Nice to see you.
So China's DeepSeek was able to build out these AI models without using some of the most advanced semiconductors in the industry that Jensen Huang even says the work is fully compliant with export controls. What does this say about the efficacy of U.S. export controls?
Yeah, I mean, well, I think that there are probably more questions than there are answers here, but clearly not the intended policy objective for sure among policymakers in terms of those export controls. Though I think that what we've seen with Huawei and other kind of workarounds is that this is more of a leaky, potentially kind of a leaky export control regime than what was intended. I think that kind of the broader question, though, is how does Washington proceed from here? Washington has been on their back foot in terms of tech regulation, for better or for worse. For instance, there's a data privacy bill that has been in the works on Capitol Hill for about a decade. So I don't think any sort of optimism that we're going to see policymakers kind of get out ahead in terms of AI or creating some regulatory framework or potentially regulatory clarity, that probably is misplaced, regardless of which party's in control, honestly.
Yeah. Well, limiting access to tech is a losing battle because tech is always evolving, right? I mean, you're only banning today's technology, not tomorrow's. Does Washington maybe double down and limit even the lower end chips to China?
I mean, I think that is, certainly on the table. What we've seen from President Trump so far is maybe a softer, gentler approach to China just writ large. But there is, and I think this is kind of the main point, a lot of focus on Capitol Hill among career policymakers that, they don't necessarily want to set China back, but they don't necessarily want to give China the tools in order to advance, like what has happened in terms of advancing ahead of the United States. So I think for all intents and purposes, the export controls that we saw under President Trump, under President Biden, will continue. And I think, again, regardless of who's in charge in Washington.
There's been a lot of talk about a potential upcoming meeting between Xi Jinping and President Donald Trump. And I am curious as to what you think their relationship is going to be over these next 4 years, particularly compared to what it was during his first term.
Yeah, I think that for a lot of things for President Trump, there are probably some kind of competing tensions, competing factors here. I think that he does have a good relationship with President Xi, one. I think there are things that the U.S. wants from China. I think that particularly as it relates to the Ukraine war, I think he believes that China is a critical kind of factor in terms of bringing some sort of settlement to that conflict. Then again, there are many advisors that have been advising Trump who feel like China did not honor the terms of the Phase 1 trade agreement. So we'll see. But I think for the foreseeable future here, it's interesting that he has not kind of moved forward with additional tariffs or levies on China. What we're telling our clients and what I'm telling our portfolio management group is don't necessarily conflate that with kind of permanent inaction here. But I think there are some things that we want from China, and maybe he's going to hold his fire.
In the broader sense, though, how effective do you think the threat of tariffs or even the implementation of tariffs? We kind of got a taste of that with whatever the heck happened with Colombia over the weekend. I didn't know we were at odds with them, but it was interesting to see.
Not anymore, don't worry.
Not
it's
anymore.
All good, yeah.
But it was interesting that he used tariffs as sort of the cudgel rather than something else.
Yeah.
And I do wonder if we should just expect that any dispute we get into, whether it's with China or Canada, Colombia, or whoever, that tariffs are going to be sort of the first weapon that he tries to use to resolve it.
Yeah, and I think they underscore, President Trump's deep-seated belief that tariffs are, in some ways more of a solution than a problem. I think this is where I think the market may confuse how kind of, again, deep-seated, how real this ideology is that underpins his threats. So will he threat? Will it be sort of more bark than bite in some cases like it was yesterday, for sure. But is he going to be afraid to actually bite? I don't think so. And I think, again, this is where maybe the market is getting a little bit over their skis in their optimism that just because we actually have seen just more threats than actual tariffs, that, again, don't confuse that with sort of permanent inaction. Obviously, February 1st, Saturday, is a deadline that he has given. I think that the threats around Canada in particular are quite real.
What about what President Trump said about oil prices? He wants lower oil prices, said he was going to ask Saudi Arabia and the other OPEC producers to bring down prices that would bring down inflation and put pressure on Russia to end the Ukraine war. What levers can the U.S. pull to achieve that?
I mean, obviously, that decision in terms of OPEC is really not in the U.S.'s hands. He can jawbone like he is doing. Now, of course, what he is trying to do, and by declaring a national emergency around energy, he's trying to basically have a whole-of-government approach to decrease energy prices. I think the issue is, and you talk to energy producers, is that we are already producing record levels of both oil and natural gas. So in terms of tweaking some of the red tape, rolling back, permitting restrictions and what have you, President Trump can do that, but it's all around domestic production. And of course, there is some sort of tipping point for energy companies, how, they don't necessarily want lower oil prices, right? That everyone has an incentive to keep those prices high. So again, I think it's going to be a bit of a balance. But in terms of the levers that he has unilaterally, he's trying to pull all of them.
I am curious about just kind of the structure of this administration. Some of the cabinet nominations that have come up for a vote have gotten through, even a couple of folks that we didn't potentially might not get through, like Pete Hegseth. Is he going to get everyone that he wanted? I mean, I know we still got RFK hanging out there this week, and of course, a big one with Tulsi Gabbard.
Yeah, I think that is an open question. Maybe, unlike Pete Hegseth, who is a Republican, had a lot of Republican support. Tulsi Gabbard used to be a Democrat. So did RFK Jr. So potentially there is a bit of a
Donald Trump.
So details. There's a bit of a partisan divide there. So we'll see. But I think that the practical kind of components here are that Republicans have 53 votes in the Senate. They only need 50 in order to get somebody confirmed, meaning that they can practically lose 3 folks and still, assuming no Democratic support, and assume people get confirmed. I think Republicans are all starting out a position of wanting to confirm President Trump's nominees.
All right, Libby, always great insights out of you. Libby Cantrill, Pimco Managing Director and Head of Public Policy. A closer look here at some of the implications of whatever the heck happened today, Scarlett, with DeepSeek and AI. And maybe, I don't know, do we get some guardrails out of there, or is Trump just going to, take this sort of hands-off approach to the industry and let them do what they want?
Well, at the end of the day, I mean, what started off looking like it would be a market meltdown didn't end up being that. It was for NVIDIA, it was for semiconductor stocks, but not for the market at large.
Yeah, I mean, I was looking for the superlatives, and I look back, it was like the worst day for the S&P be since January 10th, the worst day for the NASDAQ since mid-December. So, yeah, I mean, the stocks took it on the chin. But what about everything else, Scarlett?
Yeah, well, what about everything else? Safe havens like treasuries, like the yen, certainly caught a bid. The 10-year yield did briefly fall below 4.5%, but as you can see, came back above that level. One to watch for certainly is the yen. Firmer against all 16 major currencies. The yen carry trade suddenly becomes a lot less attractive now.
And we talk about the markets here. If you're looking to maybe potentially what the cash session looks like tomorrow, look at this, a little bit of a rebound in the post-market. We should point out, of course, isn't always indicative of what will happen tomorrow. But after that 17% sell-off, NVIDIA up about 2%. Similar moves for the rest of that space. Something to keep an eye on as we head towards tomorrow's open. Stick with us. A lot more coming up here on The Close. This is Bloomberg. Well, it's not every day that you see the type of drop in stocks like we saw today. It is a somewhat rare sell-off, but of course it raises a lot of anxiety. It causes panic, at least for the everyday investor out there and maybe some of the institutional folks as well. But for those retail traders, there's a lot of questions right now about their portfolios. A lot of people checking those portfolios, checking those 401ks. So let's try to get some insights out of somebody who really knows how to talk to these people. There's only a few podcasts that I listen to, and one of them I listen to religiously is hosted by our next guest. Farnoosh Torabi joins us right now. She is the host of the So Money podcast. Now, Farnoosh, one thing I love about your podcast is you could kind of talk it all. And, you know, everybody comes to you with some complaint, some anxiety, some sort of a fear of the world of finance, and you always find a way to sort of put it in perspective. Maybe you can put today's moves in perspective, because I know I'm going to get a lot of calls and emails and texts when I get off this set from my family members wondering what the heck just happened.
Well, first of all, thanks so much for that glowing review. I fully expect an Apple podcast reviews from you, Romy. Thank you so much. That means so much to me. And you're absolutely right that fear is the underpinning emotion with so many of our financial questions, especially on days like today. And what I always tell people is that if we expect our portfolios to perform well over the decades, we have to take the good with the bad. We have to take days like these, which actually are fewer than there are the bull days, the bullish days. So this is par for the course. And I often talk in terms of long-term investing. So if you're a long-term investor, you're not a day trader, days like this should not rattle you. If anything, if you're worried, if you're scared, hey, you know what? Fine. Take a look at your portfolio. Make sure your allocation is right based on your risk tolerance and your time horizon. But this isn't the time to be making knee-jerk moves, actual knee-jerk moves in your portfolio. If anything, it's just for you to kind of take a look, but also remember that this is what happens when we're playing the long game.
Yeah, well said. You know, one of the reasons why we asked you to come on the show actually wasn't necessarily to talk about today's moves, but it was to talk about maybe some potential impacts from the Fed's rate decisions this year, including a rate decision coming up this Wednesday. We had an election that seemed to, at least to a certain extent, be decided on how people felt about the economy and, more importantly, how they felt about inflation, a fight that at least the Fed will tell you isn't done, Farnoosh.
It's not done. And I think if we had to give this year a theme as far as how consumers are going to be approaching their spending decisions, their borrowing decisions, it's that they're going to be very cautious. They're really thinking strategically. A lot of the questions that I am fielding on the podcast and throughout the community are around whether or not to make big ticket purchases this year, whether that's a home, a car, an appliance, a renovation project. Of course, inflation has tempered over the years thanks to largely the Fed's rate reduction, but it's not that we have seen prices go down that much or significantly enough where we're just opening up our pocketbooks and spending without a lot of pause. And normally January, remember, this is the time of year when there's a lot of reflection on how we have spent over the last 12 months, and in particular, how we spent in December. Our credit cards got quite a workout. So there's normal hesitation in January, but I think to your point, yes, with uncertainty uncertainty around the Fed's moves, with uncertainty with regards to Trump's policies, whether that's in tariffs or a crackdown on immigration, all of that does have ripple effects on consumer spending and consumer sentiment. So a lot of this is just a wait and see. And so as a result, I don't think we're going to be seeing huge sort of discretionary, at least, spending numbers in the month of January.
So given all that, I mean, people are going to be cautious on their spending. How do they proceed with their investing? Tech has been the only game in town for so long, and today we saw it kind of get hit. We saw safe havens like treasuries, like the Japanese yen, like consumer staples and healthcare companies, whether it's Walmart or Johnson & Johnson, do well. But then some other safe havens like gold or even Bitcoin, for that matter, did not really hold up. So it kind of makes you question, what's a safe investment at this point when things do go haywire?
Well, I don't think Bitcoin's a safe haven, but I do agree that bonds are very much top of mind right now when I talk to financial advisors and those who are working with their clients' portfolios, particularly those investors who are nearing retirement, and they can't risk days like this happening in a pattern, at least for the next few years. We already have seen a lot of those who are market analysts anticipating the next 10 years being lower growth or slower growth in the stock market, in the U.S. stock market at least. And so I think for those of us who are actually nearing retirement, let's say we want to start drawing down on our portfolios in the next 5 years or next 10 years, we want to look at our balance. We want to make sure that we're not too aggressive in stocks and start relooking at our bond position. I know, again, this is what the professional advisors are doing for their clients.
Right. I only bring up Bitcoin insofar as it's meant to be something that's uncorrelated with the other asset classes, but in this case, it's very much correlated with technology stocks. Having said all that, the private asset industry, the alternative asset firms will tell you that private assets, private equity, private credit are not correlated with publicly traded securities. How much demand is there from your listeners for these private assets?
Not much, I can say. I mean, this may just be my perspective. I think my listeners, and I think they do capture the snapshot of the average American consumer. Most of my listeners are women. A lot of them are professionals and caring for their families or the breadwinners in their families. And they are interested in investing, but they're not really interested in alternative investments. They're actually just asking the basics still, like, how do I invest in the stock market in the U.S.? How do I open up an IRA? And should I match my company's offering in the 401k, et cetera? So they're asking the right questions. I think for the average consumer, it's really just about the basics and getting on board with investing in the tried and true ways.
Are people still worried, though, Farnoosh, about interest rates as well? I mean, just to kind of circle this back, I mean, I know at least if you're maybe in the market to buy a home, you're certainly probably paying attention to where those interest rates are. Do people, regular people, and not us finance nerds, do they actually really pay attention to that?
They do, but let's just stick with real estate here. I mean, the problem with real estate buying is not just that interest rates are higher than where people would like, and it does make the purchasing power less in the buying market, but it's also the inventory is so slim. And those who are determined to buy will continue to come out this spring and look and hope for the best. But the interest rate environment is making it very, very tough. And it's also leading to the reason why we don't have enough inventory, because those who have homes with their 3% interest rate, they're locked in. They're not looking around going, we should sell our home right now, especially if they want to buy again. They're just not seeing that as a desirable move. And so until the inventory improves in housing, I just don't see a lot of hope for prospective buyers, at least not for the many who are wanting to buy this year. With credit cards, absolutely, this is a concern. We've seen credit card interest rates now still up past 21%. So if you have variable credit card interest rate, it's an important time to relook at that debt. Can you transfer it to, say, a 0% APR credit card? It's a temporary window for that interest rate, but at least it can buy you some interest-free months, or maybe rolling that into a personal loan that has a smaller interest rate. So, yeah, I think the credit markets are still giving people a lot of pause when it comes to things like buying big-ticket items, renovation projects. HELOCs are not as attractive as they were a few years ago. And, of course, consumer spending on their credit cards.
All right, Farnoosh, really appreciate your joining us. Fantastic to get a chance to speak with you. Farnoosh Torabi is host of the So Money podcast.
All right, stick with us here. We're going to set you up for what to watch over the next 24 hours. It's going to be busy. This is Bloomberg. All right, it was a busy day, Scarlett. Potentially busier tomorrow. Here's some of the things to keep an eye on. Quite a few earnings coming out, including from some big heavyweights.
Yeah, certainly in the luxury space, right? You've got Christian Dior, you've got LVMH, Royal Caribbean to an extent. They're going to wrap up the all-important holiday shopping season, too.
I'm really curious to see what comes out of LVMH. They kind of pre-announced, and so we kind of know there's going to see a drop in fashion and some of the things. So I saw perfume sales were holding up for some reason.
It's the more accessible part of the luxury market.
All right, well, there you go. We're also going to get a couple of interesting folks. Boeing and General Motors also set to report as well.
Yeah.
So read maybe on the industrial economy as well.
Absolutely.
And that brings us to durable goods.
Durable goods at 8:30 a.m. It'll be for December, so it'll be interesting to see whether people were trying to buy things ahead of what they thought would be expected tariffs on big ticket items.
We've heard some anecdotal evidence that people were doing that. I don't know. Were you one of those people? Did you go out and buy a washing machine?
I didn't, but I definitely
refrigerator?
saw like a lot of advertising around or a lot of talk around it.
Yeah, and that actually brings us to 10 a.m. We're actually going to get an update on consumer confidence.
Yeah, consumer confidence, a big question, especially with interest rates slowly rising, at least in the bond market.
And this is all the setup for the start of the Fed's two-day meeting, a big decision on Wednesday.
Yeah, although we already know that they're not going to raise or cut interest rates. It's all a matter of the language and what they say about things going forward.
Absolutely, and we will have full coverage of that and everything in between. For all of your politics coverage, stick around. Balance of Power is coming up next, right here on Bloomberg.